Welcome to Blind Spots, a podcast where we're helping you fill the gap between what you want to do with your money and what you actually do. We are professional investors, writers, and financial planners helping you navigate the complexities of finance to optimize what you can control and cut out the rest. Join your host, Nick Shermans and Aaron Varghese, as we discuss the questions and nuances surrounding everyday money management. Hello, everyone. Welcome back to another episode of Blind Spots. In this episode, we are talking all about the 5 things to avoid if you are retiring in 2024. So these are blind spots, pitfalls, and just things that we've noticed from speaking to clients and prospective clients that we think would be helpful for you to know about and recognize in yourself so that you can avoid these mistakes.
And so these are 5 investment mistakes or just 5 mistakes?
Investment mistakes.
5
I'd say it's more
investment
focused
mistakes.
that way.
Yeah. And some of these things are as old as time. Some of these things are flaring up given the market action this year. So we can walk through each of these. And these are things that we observe in practice. So we're not picking on anybody, but if you can be aware of some of these pitfalls, I think you can make some better decisions and perhaps have a smoother ride in your retirement.
So let's kick it off with the first one. We've talked about this a lot before, but we would be remiss if we didn't mention it again, especially since this podcast is called Blind Spots. We love talking about the psychology of money. So talk about the mindset shift from working to retirement.
So there's a subtle but important shift that needs to occur when you go from working, earning, and saving to being completely retired. So you have no income coming in. Perhaps you're living off your portfolio, but oftentimes people never make that shift. And think about the skill set that's required to build wealth, right? You're working, you're saving, you're earning, maybe you have a side hustle, you're taking risk, or you're more open to taking risk because you're trying to grow your balance sheet. You're trying to build so one day you can not worry about money, plant your flag in the ground and say, I have enough. Problem is, most people don't turn that switch off. They're still in wealth building mode when they finally retire. And I've said this before, but the skill set for building wealth and keeping wealth are completely different. The former involves risk-taking, maybe leverage, debt, speculation, right? Because if things don't go your way, you have time and human capital, earning capacity to build it back, right? Once you retire, your future earning days are essentially gone. Sure, you could go back to work, but most people that retire aren't doing that with the intention of going back to work in a year. Okay, so
Right.
Keeping wealth requires prudence, patience, maybe even shunning a good investment opportunity, planting your flag in the ground and saying, my body of work is done, my wealth building mindset is behind me. I'm going to exercise caution. I'm going to perhaps invest a little more conservatively. I have enough.
In practice, how have you seen clients fall into this mistake where they're not making the mindset shift?
They're trying to squeeze every basis point, percentage point in performance out of their portfolio. They're reaching for return. They're reaching for yield. They're leaning over their skis. They're taking more risk than they set out to. They're following benchmarks and wondering why they're not up as much as the S&P 500. Okay, that's very much a wealth building mindset. And I always tell people, you should not take risks where the best case outcome doesn't change your life. Like if you take your $1 million and you have more than enough and you turn it into 1.8 million over the course of a year, sure, you might feel good, but it's probably not going to change your life, right? But if you took your $1 million and you turned it into 400,000 because you were speculating and reaching, that would probably adversely affect your plan and you'd feel pretty bad about it.
Mm-hmm.
But yet that's what so many people subtly do because they're still in the wealth building mindset and they have concentrations in tech or maybe in cryptocurrency, or they're still focused on keeping their foot down and squeezing every last bit of return out of their portfolio. And look, I'm not saying people should not want to see their portfolios grow, but if you're obsessed about performance and obsessed about benchmarks and all that, and you have no idea how much risk that you're taking, you're probably doing it wrong, and it might not end well. Because if you engage with history and understand the range of potential outcomes by investing heavy in tech and having a concentration, it might open your eyes.
At what point in your working years do you start to make the downshift? Is it a year leading up to retirement? Is it 5 years? Is it the day after you retire? What does a timeline look like?
Yeah, that's a good question. Certainly, if you have a taxable account with deep embedded gains, that could factor into it. It depends on what other income you have outside of your investment portfolio. It depends on if your spouse is still working or if you're single. So there are some considerations, but ideally, we always tell people it's encouraging if you have income that's not tied to financial markets and your plan still works, meaning you don't need 12% a year or 15% a year to achieve your retirement goals. Like, it's a really good place to be if you assume a zero rate of return in your investable assets and your retirement plans still work. Mm-hmm. Now, most people would say, hey, that's stupid, but that is an empowering place to be if you don't need 10% a year or 5% a year even for your portfolio to work. So to answer your question, it's going to be different for everybody, but I think you should have a systematic rules-based process for slowly dialing down risk in your portfolio, right? So maybe that means taking, if you're going to retire in 2030, maybe over the next 5 years, you slice off 5 to 10% each year from equities or 3% each year from equities. That might help smooth that process out. You don't have to market time. You don't have to try to top take. Like, you're essentially taking the guesswork out of it. So I'm big on rules, less on gut calls and emotion based on short-term market noise.
How does mental accounting play into this? I think I hear a lot of people say, I'm going to take a risk with this piece of money, but this is my kind of safe assets.
Most people do that, and I can tell you it can become confusing. It can become scattered. You could hold more cash than you set out to. You could be taking more risks than you set out to if you're looking at things in a silo. So I would encourage people to look at everything. Look at your entire balance sheet. Look at your entire portfolio and understand where things could go wrong, right? The market doesn't care that you've earmarked this money for that or earmarked this money for something else. You need to take an objective, non-emotional look at it, which is why a lot of people hire advisors, because the closer you are to the money, the more emotional things become. And mental accounting to me is just an emotional response to money.
Yeah, I agree. Okay. Continuing on the psychology of money train, we also talk a lot about cognitive and emotional biases, and we've done an entire podcast on those. But one that comes up quite frequently in our day-to-day is recency bias. So talk about how that relates to the investment world.
Yeah, so I'll weave in some current examples, but recency bias is essentially investors overweighting what just happened. Mm-hmm. So from 2022 going into 2023, people thought the world was ending. They thought the dollar was collapsing. The U.S. was going to, default on their debt. The dollar is going to go away. Markets were going to tank. Like, pretty much every corner, from social circles to social media, people thought things would get worse from 2022 to 2023. Mm-hmm. What they were doing was overweighting what just happened. And 2022 was a dumpster fire year for every asset class as rates went up and inflation was raging. Okay. And it works the other way too. So go 1 year back from 2022, back in 2021, and there's some element of this now. People couldn't miss. You could throw a dart at a newspaper, land on any ticker, and you probably made money. That was during the NFT cryptocurrency spike, SPACs, special purpose acquisition vehicles, where people were setting up companies, funding them with cash, and giving the owners of the SPAC a blank check to go out and buy stuff. So people were buying stocks without knowing what they were buying, right? Mm-hmm. Not knowing what the SPAC was going to buy. So it was peak whatever, zero rates, speculating. Markets were raging pretty much every corner of the globe. Okay, people thought the good times would continue. All right. So again, in both cases, either bad or good, overweighting what just happened, which can lead to performance chasing, FOMO, the fear of missing out. Like, tech stocks are doing really good. People piling into that corner of the market. Bitcoin's doing well. Folks piling into that corner of the market. So I say this all the time. Cycles are different, right? What drives each cycle, if it's good or bad, the human response is very much predictable. People are greedy when prices are going up. People are fearful when prices are going down.
What's another cycle in history that you can think of that really sparked a lot of kind of performance chasing or maybe sparked some of that recency bias in people?
Well, I mean, I pretty much see it every day. But one that's really popular is folks that manage their own 401k plans will often just look at the best performing funds over the past 1, 3, and 5 year, and they'll allocate to those funds.
Mm-hmm.
And going back over 100 years of data, that's probably the worst strategy because what's performed well usually has a period of underperformance following that stellar performance. Okay. So back in 99, 2000, that probably was the most egregious example. And I was in high school during that time. But I still remember companies that were struggling, companies that were not making any money, would slap .com after their company name.
Mm-hmm.
So a company, Pets Inc., would all of a sudden be called Pets.com and the stock would go up 100%.
Yeah.
All right. That was probably the most egregious example. And I think people incorrectly draw a line between that tech bubble and this tech bubble. So I'm using quotes here. But the difference today is these big tech companies are actually making money and making products that we all love and use. Back then, it was the Wild West. .com on any company name saw their stock go up, even if the company was saddled with debt or had poor sales or shrinking sales. It didn't matter. So that was probably the most egregious example back in 99, 2000. And know that professional investors got sucked in too, because if you think about it, a lot of these mutual fund managers are like their compensation is tied to how they perform relative to a benchmark. And if you did not own these tech stocks, it was 100% guaranteed that you were going to trail. Most investors and professional investors are not immune to this, would rather fail with the herd than be out on an island by themselves. So you saw a lot of herd behavior piling into those tech companies. And of course, the NASDAQ ended up crashing by like 70%. People lost their livelihoods, their jobs. They went back to work. It was an absolute dumpster fire.
Do you think that you'll see that happen again this cycle?
I don't think that dramatic, but I would never say never. There's certainly an attitude for investors that started investing post 2009 that it's U.S. stocks and everything else. Like U.S. stocks over the last 16 years have been an absolute juggernaut. And one of the things I'm writing about this week in my blog is why it might not be a good idea just to take 100% of your retirement assets and put them in the S&P 500. There's several potential yellow flashing lights. Look, and I'm not saying that you can't generate a positive turn with the S&P 500, but if you think investing is as simple as buying 100% in the S&P and checking out, you probably have another thing coming.
Sure. Continuing kind of on the same line, our third pitfall or a mistake you should avoid if you're retiring is about engaging with history. So it's kind of following along the same lines, but talk a little bit more about how people should frame historical returns in order to make decisions for the future.
Well, when people say things like, hey, I just want to own the S&P, or I'm comfortable with this growth fund because it's done well, or, it's fine, my portfolio is 60% and a handful of tech stocks. To me, that just screams you haven't engaged with history and you don't understand the range of potential outcomes. Okay, so there's been long stretches where U.S. stocks have been essentially flat, right? From 2000 to 2009, the U.S. stock market was flat, meaning if you invested $100,000 in the U.S. stock market in 2000, you would have had roughly the same amount of money. Sure, you would have had some dividend income, but the price level was essentially flat. No one was pounding the table wanting to invest 100% of their retirement assets in the S&P 500 at that point, which kind of makes my point about the recency bias thing. Mm-hmm. But I think a true professional understands history, understands if you're a 100% equity investor, a drawdown of 50, 60% is not only possible, but it's probably going to happen in your lifetime. And the last time it happened was 2008, where peak to trough, the S&P was down about 60%. Mm-hmm. Back during the COVID sell-off, the S&P was down about 37% in 30 days. So there's no warning, there's no shot across the bow that this stuff is coming. but you really do need an iron stomach to have exposure to equities. And I think people just forget that these wide range of outcomes is possible. And so again, going back, reading less about predicting, less about forecasting, and engaging with history, and you'll likely develop a better risk management framework to make investment decisions.
Is determining a retiree's risk tolerance or capacity to take on risk more so about their ability to stick to a long-term investment objective on the downside, or is it just overall total return, including bonds, to have some more predictable income?
So I'm not sure if I'm answering your question, but good investing.
I don't know if I asked a coherent question.
No, it's a good question. But good investing is not maximizing your return every single year. That's a recipe to get your face ripped off. Good investing, if you understand the nature of compound interest, is generating consistent returns for as long as you possibly can. That's how wealth is built. Generating reasonable returns or consistent returns over the longest period that you can. That's sound investing. It's a plan that you can stick to. So in order to do that, at the first sign of stress, the first sign of a market downturn, you need to be able to stick to your long-term investment plan. That's the best investment plan for people is one that you can stick to when things get really uncomfortable. Okay, that might mean 20% bonds for you. It might mean 40% bonds for me. Whatever that number is, and I think like the right portfolio is built by identifying your range of acceptable outcomes today. And I say that all the time, but I really mean it. Like a lot of people think good investing is taking as much risk as you can. Market goes down, you go in and make a bunch of changes, or you're constantly tweaking based on ebbs and flow in the market. It's like that's not that's very amateurish. That's a recipe to make mistakes over and over again. Good investing starts today. It starts during a non-crisis time, being honest about your capacity to take on risk, looking at your past behaviors to see how you held up during times of stress, identifying the range of outcomes in percent in dollar terms. Like, hey man, I've got $1 million. If I lost $100,000, I would lose my absolute mind. Okay, so build a portfolio that reflects a potential max drawdown of 100,000. Like that's a good starting point. Mm-hmm. And then have a framework for making decisions going forward. I'm not saying you should just buy and hold. Have a framework for dialing risk up or dialing risk down that's not based on emotion or short-term market noise or what your friends are doing.
So you said something interesting that I think people may not agree with. You said, make your decisions now while times are not weird. But I think a lot of people would stop you and say, I don't know, this feels really uncomfortable. There's a lot of noise. I'm hearing XYZ. So what makes you say that times are not weird right now?
Well, I'm just using that as an example. Like this. So what I meant by that comment, this is not a crisis time, right? Like the market's not falling 3-4% a day like it was during COVID.
Sure.
All right. So people should build their long-term investment plan, their long-term portfolio during a non-crisis time. Okay. And if you have a propensity to lean a certain way, like if you're a perma-optimist, right, or a pessimist, you should so if you're a pessimist, and I've said this before, you should add equities or risky assets in case you're wrong. Okay. If you're an optimist, right, you should acknowledge these biases and say, okay, I'm an optimist. I think stocks are going to go up over time. You should hedge yourself with some bonds or gold or other assets that are safer in case you're wrong. Mm-hmm. So it all goes back to the behavioral side, where you need to be in tune with what your natural bias is, either pessimistic or optimistic, and work out natural hedges in case you're wrong. And back to my comment, and I'm going to repeat myself, but I think people that make allocation decisions or make portfolio changes during a crisis time are acting on emotion. And I think you should get in touch with your ideal long-term portfolio when times are good, but with the caveat of the recency bias thing, right? When times are good, you have the you have the urge to maybe take more risks than you set out to.
It's tough out there. Tough to make decisions.
Well,
Okay.
it's tough. It's tough for people to be honest with themselves. Like that's what's tough. It's tough for people to look themselves in the mirror and say, okay, I've made some mistakes in the past, or this is where I keep making the same mistake, or this is my natural tendency to think things are going to get worse or better, which again is why people hire advisors, because we have a clean, objective look at everything. And I've said this before, only you, the retiree, or you, the investor, know the blood, sweat, and tears that went into building your nest egg. That's a natural human response to get emotional about that money because you're so close to it. And it's also the reason why I'm going to have either a rule-based process when I'm done working, or I'm going to hire my own advisor, because I know that everybody has baggage. I have baggage. And it's part of the reason why we built our investment portfolio and our framework the way that we have, because I want to strip all of that human blind spots, emotions out of the investment process.
Okay. These are kind of falling in line one after another. So the fourth pitfall that we don't want retirees to fall into is not having a reactionary approach. So we kind of touched on this just now about, you know, having your long-term investment objective kind of set during non-crisis times. So talk about what happens when we are in crisis times and what you see people do.
So a lot of people think good investing is building a portfolio, get while the getting is good, seeing your assets go up, and then once the stuff hits the fan, they go in and make a bunch of changes. Okay? That's not a process. That's very emotional. Okay? So there's a few things you can do to mitigate that. One, I think you need to be honest with yourself about your past behaviors. Like, investing doesn't work where you just only enjoy the upside and you shun losses. So negative outcomes are part of investing. I think once you embrace that, I think it becomes a lot more simple. You also need to look at your past behaviors. So if you made an ill-timed sell, like at the bottom during the COVID sell-off or something like that, I think you need to go back to the drawing board and look at your process. The other thing I always recommend to people, and a lot of folks find this weird because not a lot of advisors talk like this, but I encourage people to set up a flush trading account where they can day trade, they can swing trade, they can express their active views. I think that gets out a lot of their like degenerative side. Like you want to do, like people tend to want to do something when the stuff hits the fan. And I think that's a good way to scratch that itch. Okay,
How much of your portfolio would you do in that type of account?
Anywhere from 5 to 10% is a reasonable mental shortcut. Okay. The last thing I'll say about that is you really need to have a process for making buy and sell decisions. All right. Seeing a report on CNBC about how things are going to get worse, or talking to your buddy who's predicting a crash and then going back and making like that's not an investment process. That's an emotional reactionary process. So have a preset framework for making risk management decisions, either adding risk, adding to equities, or selling equities and adding to safe asset classes. And it should not lean into short-term market noise because you're going to be confused. There's always stuff to worry about. Okay.
Okay. Last but not least, our fifth pitfall or mistake not to fall into is having a social or information filter.
Yeah, and people can't help themselves. Probably one of the most popular questions I get is, what are your other clients doing? And I think that's just the wrong question. Like, everybody's playing a different game. And I think you need to identify the game that you're playing. Don't worry about what the guy down the street's doing. Don't worry about what other high net worth investors are doing. Everybody has a different playbook, a different circumstance, different needs, a different plan. All right. And I think this is more important than ever because you're not only getting it from your social circle, right? Your friends and family that, although they're well-intentioned, are probably offering advice that makes sense for them, maybe doesn't make sense for you. But if you don't understand that, then you're going to end up just grasping at every idea that someone throws at you. Throw in our cell phones, human cyborgs. You wake up every day, you got Apple News, you got stock prices flashing across your phone. You've got social media, you've got CNBC and Bloomberg TV. I mean, humans aren't meant to process all of this information. And again, if you don't understand the game that you're playing, if you don't understand context and what's appropriate for you, you're going to drive yourself crazy and you won't be able to make a decision, or you're going to just make a bunch of decisions every single day that send you off on a wild goose chase.
Yeah, the information filter thing I think is a big one. And on the planning side of things, I think I see this most where, particularly when we look at a balance sheet, I kind of get this a very similar question between clients. Is this what's average for a retiree? Is it normal to have this much in a 401k versus a taxable account? Or, you know, does real estate normally take up this amount of a balance sheet? And, you know, there tends to be an average, you know, between similar types of clientele, but everyone's situation is so different. So not comparing yourself can be difficult, but it's important, like we've talked about.
Yeah. So we covered a lot today. In my opinion, the most important rule to keeping it on the rails as an investor once you retire is shifting from the wealth building mindset to the enough mindset. I can't stress that enough. And it's a subtle but important shift. So many people have gone off the rails by not making that downshift. To assume the same mentality, the same portfolio is appropriate when you're not working, it usually doesn't end well. Okay. The most underrated and understated rule that we covered today is having that information filter. Be very intentional about who you take advice from, what sites you read, what blogs you read, because what we consume, our daily habits and what we read and consume makes up our identity. And it's really hard to operate in the digital world without a filter because, you know, again, you're going to just make your life miserable.
So we talked about the 5 mistakes not to fall into. I've got a few just opinions, phrases, things that I want you to agree or disagree and tell me why. So here's a few for you. Number 1, the stock market is like gambling.
That's the stupidest thing I've ever heard. The
So
stock
disagree.
market, that's a strong disagree. And essentially when someone's investing in the stock market, you're buying ownership shares of a business. Like you're not buying paper, you're not buying an idea, you're not buying a meme stock, you're not buying numbers on a screen. You're buying ownership shares of a company. You are an owner of a brick and mortar company, a tangible company that has people working for it, that has assets, both tangible and intangible, that hopefully makes money. So you're very much an owner. Now, the flip side of that is there are elements of the market that involve hedging and speculating and leverage. Think options and warrants and derivatives and futures and commodities and all that. So there is an element of that. But for most people, just to blanket say the stock market is like gambling, I think that's ridiculous. Because if the stock market was a casino, right, and you walked into that casino and your odds of winning over time were like 100%, right? So, you know, I've shared this in the past, but I've got it right here actually. So since 1928, the S&P total return, percent of time returns have been positive, are 100% over any 16-year rolling period, right? So there's no casino on earth where you walk in, and if you stayed in there for 16 years, you would have a 100% probability of a gain. No casino exists like that. So it's not gambling, because gambling, you know, you're probably going to lose. But markets, the longer your horizon, the more, I hate to use the word certainty, but there's a higher probability that you're going to have a favorable outcome.
Okay, next one. You can be successful in timing the markets if you buy low and sell high.
No, that's nonsense. That's nonsense. No one can time the market. Like there's no warning signal that says this is the top or this is the bottom. And the worst thing that can happen to someone is actually timing the market correctly once, because you're emboldened with the confidence that you can do it again and you think you have some sort of sharp edge. I've seen more disasters strike from someone having an early success in investing and trying to play that movie forward and do it again and again. They always end up with egg on their face. So if you're agonizing over when to get invested and you're waiting for a pullback, just invest the money, right? If times are really tough and markets are down, just invest the money. If markets are up and they're at all-time highs, just invest the money. That's usually the best approach for someone with a longer-term investment horizon. Now, someone that needs the money in a year or a year and a half or 2 years, probably don't invest the money, right? Put that in a money market account. So you have to match your assets with the liability side. Okay.
The only thing I'd add to that is that low and high is relative. So, who's to say where your entry and exit point is?
Right. And just to follow up on that, people get scared of all-time highs, right? Back in 2021, there were 70 all-time highs.
Yeah.
Like back in 2020, there was 36 all-time highs. So all-time highs are a normal function of upward trending markets. Like when a market's going up, it has to hit all-time highs, right? So that's not something that should be shunned or a reason to be conservative or to wait to invest.
Okay, next one. Only wealthy people can invest, or investing is an exclusive or elite club.
Nonsense. Might have been true in the 80s or 90s. Now I can click buttons on my phone and invest fractions of a cent or, fractions of a share or, a dollar each transaction. There's so many sites out there that are trying to address the lack of financial savvy, the lack of savings for the average American. If you're using investing is only for wealthy people as an excuse to start investing, I think you need to look in the mirror and find the root cause of that, because that's just nonsense.
Okay, last but not least, significant returns should be expected quickly when investing.
No, people get in trouble when they try to shrink the natural wealth building mechanism of the market. Time, savings, compounding. Like that's the recipe for building wealth over a long period of time. People get in trouble when they try to take a 30-year time horizon or a 30-year goal for their investment portfolio and squeeze it into a 3 or 5 year period. You cannot reach for return and expect to generate outsized returns without the equivalent risk. And there's both sides to every trade. The more that you reach, the wider the range of potential outcomes. So don't try to take something that's going to happen over 20 and 30 years and squeeze it into a 3-year period. That's a recipe for disaster.
Okay, I think that's good on our agree, disagree opinions from Nick today.
Well, I think I disagreed with mostly all of them, and a lot of them felt like entrapment. So good job.
Thank you. All right. Thank you for listening to this episode of Blind Spots. We will see you in the next one.